Did you know that over 70% of retail investors lose money because they skip one simple step? Analysis? If you want to avoid that trap, stick with me. Today, I'm breaking down 5 practical steps to analyze any company before you invest. Whether you're brand new to investing or just want to sharpen your game, these tips will help you make smarter decisions. Alright, let's dive in. Step 1. Read the financial statements. Every company releases 3 major financial statements: the balance sheet, income statement, and cash flow statement. Think of these as the company's report cards. The balance sheet shows what the company owns and owes. The income statement reveals how much money it's making or losing, and the cash flow statement tells you whether the company's actually bringing in cash or just spinning its wheels. Step 2. Analyze revenues and expenses. You want to spot trends. Are revenues growing year after year, or are they flatlining? What about expenses? If costs are rising faster than income, that's a big red flag. Look for patterns over 3 to 5 years, not just one lucky quarter. Step 3. Check profitability ratios. Here's where it gets interesting. Ratios like gross margin, net margin, and return on equity, or ROE, tell you how efficiently the company turns revenue into profit. The higher these numbers, the better, but make sure you understand what's typical for the industry. Step 4. Compare with competitors. Don't analyze a company in a vacuum. Stack it up against its biggest rivals. Are their margins better or worse? How much market share do they own? Benchmarking helps you understand who's leading the pack and who's falling behind. Step 5. Assess the risks. No investment is risk-free. Check how much debt the company's carrying and whether it's exposed to volatile markets or external threats. Are there lawsuits, regulatory issues, or economic headwinds? Make sure you're not investing with blinders on. Let's tie it all together with a simple example. Say I'm looking at facility management company first. I pull their latest financial statements. I see their cash flow is steady, but their debt just jumped. Next, I check their revenues up 12% over 3 years, but expenses rose almost as fast. Then, their net margin is 8%, which I compare to industry peers averaging 10%. That's a sign facility management company might be lagging behind. But, when I look at competitors, I notice facility management company has the lowest debt ratio, which could be a strength in a downturn. Finally, I assess risks, and see they're exposed to a new regulation that could squeeze profits next year. With all this info, I make a more informed decision, instead of guessing. If you found these tips helpful, hit that like button, subscribe to Cash Lap for more straight-to-the-point investing guides, and check out my other videos linked in the description. Here's to smarter investing.